As the markets continue to rally, one technician says it could be time to ditch growth for value. Let's go off the charts with Mark Newton of Newton Advisors. Hey, Mark, what are you looking at?
Hi there. So we've seen a big rally and an even bigger period of uncertainty. And so you take a look at the S&P just in the last couple months. We've moved up 400 points in 33 trading days. That's about 17% or about 0.5% a day. A big move. Let's take a look at what the key levels are. Initially, 2630, we managed to get through that. That was the first level that most people thought could stop this rally. Then we got above 2715. That was the second level. So if anything, the market still has a lot of upward momentum on a weekly basis. What are the near-term concerns, though? One, Treasury yields are not really following stocks. They've been subdued. You're starting to see a little bit more of a defensive rally in the near term. Even with this move in the last couple of days, utilities and staples have been number 2 and 3 in terms of performance over the last 5 days. You're also seeing a little bit of signs of near-term momentum deterioration. It's not much, but in general, you want to watch for evidence that this rally could be starting to show short-term signs of peaking out. My thinking is, in general, it is a good move. We've gotten above key levels. Even on a near-term pullback, that would be something to buy into, simply because the sentiment has gotten incredibly subdued, and there's still a lot of concern out there about a lot of the right reasons. So what else are we looking at? Technology. I don't like technology here. I think we've had a big move. However, we've gotten up to levels that really are important. When you look at the 200-day moving average, this was important throughout most of the last couple years. If anything, you look at equal-weighted tech, that's also up near former highs, as well as the SOX, right near 1385. What should we look at? What to go into? I would suggest financials make a lot of sense here. This sector has been under pressure now for the first time, really. In the last week, we're seeing XLF break out above the entire downtrend since last September. That's where this group peaked out. So if anything, financials are starting to gain a little bit of steam at a time when technology has been very overbought. So what financials would you want to buy? I still like financial tech, the credit card processors, Visa, MasterCard. However, JP Morgan stands out to me as being really interesting here, only because we've gotten above this prior area of former lows. It really held the stock the entire way down. Now we've bounced and we're getting back up above this just in the last couple of days. So granted, Berkshire and JP Morgan make up a lot of XLF. This seems to be one to follow in thinking this rally can continue.
Mark, just to bring you back into the conversation we were just having, where does energy fall into all of this?
Energy has gotten a little bit more constructive. We had one of the better months in recent memory in energy in January, and of course that was given back over the last month. I think the move in Saudi in the last couple days is really constructive for WTI, and so I like XLE, I like OIH. I think those are better than things like the exploration and production area. So in general, I think crude probably rallies up to the low 60s. Energy is probably something to still favor during a bullish time of seasonality in this group.
All right, Mark, thank you. Good to see you. Mark Newton of Newton Advisors. Dan, I think we all know where you stand on financials, but...
listen, I like Mark's work, and if he's telling me that the S&P is stalling out here, I could look at the financials, I could look at the bank stocks and say they have stalled out. They are down in this month versus where they were at the end of January once they had all been done reporting earnings that were actually not that bad. And so if I look at JP Morgan, 2 weeks ago was 105. It's 103 today. Citibank, same thing. Bank of America. The investment banks, Morgan Stanley and Goldman Sachs, act horrible. Morgan Stanley is one of the worst looking charts, I'm telling you, in the entire market here. So I agree with his broad market call. I don't know why you would go into a group that is underperformed over the last 2 weeks as the S&P has made new highs consistently on what feels like vapors.
So, I mean, you make some very good points, but let me give the other side. Let me give you the bullish case to it. We just talked about oil going higher. We just talked about inflation picking up. What's going to happen to the yield curve? That yield curve's going to steepen. It already is a tiny bit. It's not a massive steepening. But if that happens, to the extent that investors think that the yield curve drives bank earnings, that could be very positive for the banks.
I feel like BK is so incredibly bullish tonight.
I love the
maybe I've turned over a new leaf.
Maybe it's a bull suit he's got on zipped up in the back.
Perhaps it is.
You know?
That's a guarantee the market's going down.
I don't know what suit I'm wearing. I will tell you that my view is the same I've had on financials probably for the last couple months. I look at money center banks. They traded around 8.9 times 2020 earnings in a long-term range of 8.2 to 11.3. Banks are telling you it's a recessionary economy. Regional banks, we've had M&A activity, a driver for that sector. Regional banks trade well through their long-term PE around 9.2 times versus 9.8 to 13.5. Banks are cheap by any metric, and that's the most important thing.